President Trump says April 2nd is Liberation Day because that's the day the United States will unleash the biggest wave of tariffs that we have seen yet. And now you're probably wondering, what are these tariffs going to look like? What's it going to do to the stock market? And what is this going to do to the prices of things? And if that's the case, you're in the right place because I'm going to break it all down in this video. So let's start by talking about what are these tariffs going to look like. The exact plan is going to be released on April 2nd. We're probably going to see a ton of modifications, but on April 2nd, we'll find out exactly what the Trump administration is talking about. Up until now, it's all been rumors. We've heard rumors that they want to impose a blanket 20% across the board tariff on countries around the world. But we've also heard President Trump say that, quote, he may give a lot of countries breaks. So expect a lot of tariffs on countries from around the world, but we don't know exactly what that looks like. Which brings us to number two. What is this going to do to the stock market? Well, Capital Economics has said this, quote, the only near certainty is that the effective US tariff rate is heading to the highest level since the 1940s. And the stock market generally does not like uncertainty. And while history doesn't exactly repeat itself, it does rhyme. If we take a look at what caused the biggest drops in the stock market in March and the biggest drops in the stock market in February, they both went back to tariffs because there was a lot of uncertainty and that concerned investors. So there's a chance that the Liberation Day and more tariffs could create more uncertainty, to create more volatility in the stock market. But of course, time will tell. And then number three, what is this going to do to the prices of things? And you have to remember, tariffs are a tax. It's a tax paid by the person that's actually importing the goods. And we've seen a lot of tariffs get imposed up until now. And President Trump was recently asked, what do you think is going to happen to the prices of foreign cars now that there are taxes, a tariff on foreign car imports? And what Trump said is, quote, I hope the foreign car companies, raise their prices, because if they do, people are going to buy American-made cars, which indicates what the goal of the tariffs are. The goal with the tariffs are to, number one, generate new tax revenue for the United States government to help subsidize tax breaks. And then number two, to encourage businesses to build in the United States, to bring more manufacturing in the United States, to bring more jobs in the United States, to hopefully to continue growing the economy here. So let's break down what all of this means and how this can create a potential investment opportunity for you, starting with really understanding who pays the price of tariffs. Because at the end of the day, every tax, whether it's a corporate tax or a consumer tax, is paid for by consumers. You are the one that pays the price no matter what. Now you might say, well, Jaspreet, how am I paying the price for a corporate tax? Because corporations are not humans. Every human who owns a corporation, or every human who works at a corporation, or every human who buys from a corporation is the one that is paying all the expenses. So when Microsoft has to pay their lease, it's paid for by the consumers who are buying things from Microsoft because that's where they get their money. When Microsoft has to pay a big tax bill, that's paid for by the users of Microsoft. So every cost is paid for by users. And in this case, a tariff is a tax charged to businesses generally who are importing products from foreign countries. And now when a business has to pay that additional tax, the additional fine, the additional fee, call it whatever you want, that cost ultimately is going to be paid for by consumers. Now, a corporation can either keep the prices the same and hit their profit margins, or they can raise their prices and then consumers have to pay more money to buy that product. And this is where the general consensus is that we're going to see the prices of some things rise. The Federal Reserve Bank says that it might be some sort of transitory inflation. We'll see what ultimately happens. But the question ultimately for you is, how do you find the opportunity here, and where does this create opportunity as an investor? Should you panic? What does this all mean? And of course, we cover all of this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors reading Market Briefs every day, and it's completely free. So if you have not joined Market Briefs yet, I have the link for you to join down in the description below. Now, we talked about a little bit earlier in the video how markets don't like uncertainty. And we initially saw the 2025 stock market downturn when we heard about tariffs coming in February. Then markets rebounded when Trump said that he's going to pause a lot of the tariffs. Then we saw again the downturn in March when the tariffs restarted, and a lot of investors said, oh no, these tariffs are actually real, and we don't know what's going to happen in April. If April is anything like February or March, it could create a lot more volatility once the news of tariffs actually go live. But this is where the question ultimately becomes, what does this mean for you? And I want to remind you that opportunity is there for those that are willing to take a risk. And as an investor, your job is to find a good investment at a good price. Now, a lot of times when you have downturns, you're going to hear the news that markets are crashing, that things are going wrong, the economy is going to crap, and there's all these bad things happening, which create a lot of fear, it creates a lot of anxiety, and it creates a lot of panic, which causes people to sell and run away. But for the financially savvy, it can also create a good buying opportunity if you are a long-term investor who's buying a good investment. And that's what I want you to think. Are you a long-term investor? Can you find those good long-term investments? In order for you to actually do that though, the first step to make any of this happen is you got to get your money in order. You got to get a money system. Something like 75, 15, 10, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, 10 cents is the minimum that you save. This is a simple rule of thumb, a simple way that you can start. And I know every time I say this, you might say, well, Jaspreet, I'm barely struggling to pay my bills as it is. How do you expect me to live off of 3/4 of every dollar that I earn? Well, think of it like a tax. If the government raised your taxes, what are you gonna do? Complain, cry, scream. Eventually you'll find a way to pay it, because if you don't, you're gonna go to jail. So think of it like a tax and put money aside to save and invest. Once you have money to invest, now what you wanna do is come up with your strategy. And if you've been subscribed to my channel, you already know that there are two ways that you can invest your money into the markets. You can be more of an active investor or more of a passive investor. What I like to say is that the average person should probably be a passive investor. Now, look, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But a passive investor is not somebody who's trying to find the next Nvidia. You're not trying to find the next Amazon. You're not trying to find the next Apple. All you're trying to do is own a piece of the economy. And the way you do that is you want to identify some funds that you want to invest in. These funds give you exposure to maybe the broad economy or to a broad index. For example, the S&P 500 is a group of the 500 largest companies in the stock market. If you wanted to invest in that, you don't have to go out and find all 500 companies and then manage your stock market portfolio. You can just invest in a fund that's giving you exposure to the S&P 500. You can find a fund that gives you exposure to the Dow Jones, a fund that gives you exposure to the NASDAQ. There are even funds that give you exposure to the total stock market. And now you follow a strategy like ABB, always be buying. And with the always be buying strategy, what you do is you set up a system that's automatic, where every week or every 2 weeks or every month, money gets pulled out of your checking account or savings account, and it's automatically invested into your portfolio of funds. This happens when markets are up. This happens when markets are down. This happens when markets are sideways. This happens when it's raining. This happens when you have a Democrat in office. This happens when you have a Republican in office. This happens no matter what. The key is always be buying. The A stands for always. And I get this question a couple times a week. Jaspreet, based off of this or that, does ABB still apply? Based off of tariffs, do ABB still apply? Based off of a trade war, does ABB still apply? Based off of inflation, does ABB still apply? Based off of all these concerns, does ABB still apply? I want you to remember, what does A stand for? Always. The key to win in this strategy is you have to be a long-term investor. Now, I'm not talking about 1 or 2 years. I'm talking about 10 plus years. The more years, the more decades, the wealthier you will become. If you have 20, 30, 40 years ahead of you, ABB has been a proven strategy to build wealth over the long term. It's been time tested, time and time again. You can look at the stock market performance over the last 100 years and see how it has fared when you have decades to invest into a strategy like this. Now, for some of you, that's not exciting enough, that's not fun enough, and you want to be a little bit more involved because you're a little bit more financially savvy and you're a little bit more of a financial nerd. I get it. I do this passive strategy. I also have an active strategy. Now, when I say active investing, I do not mean trading stocks. That is a way to gamble your money, and that's not something I am a fan of, nor something that I understand. When I talk about active investing, I'm talking about looking for where the money is moving, looking for market shifts, looking for opportunities, but more specifically, looking for how movements create an opportunity for you to buy a good investment at a discounted price. When everybody else is running away, that's when you can come in and find a good opportunity. This is what active investing is. Again, it's not trading, but it requires more work, where now you're going to be looking for companies, you're going to be analyzing the companies, you're going to be doing the research to see where the money is moving, you're studying the economy, you're studying policy changes, you're studying where Wall Street is moving their money. There's a lot of ways that you can analyze this, but the key is you're looking for where the opportunity is shifting, and now you want to find a good opportunity. When you find a good investment at a discounted price, now you can come in and buy. The key is not to try to time the market, but to find a good investment at a great price. But it requires more work. It also comes with more risk, because you could be wrong. You could be wrong about the shift. You might think that, well, tariffs mean that more manufacturing is going to come in the United States, so you're going to invest into construction companies that are building manufacturing plants. Well, what if the tariffs don't actually go into effect, or they don't bring the manufacturing into the United States? That could be bad for your shift. Or what if the tariffs do bring manufacturing into the United States, but the company that you invested in to invest into building those manufacturing plants goes bankrupt because they mishandled their cash? The shift was accurate, your company was not. So you take on more risk for more potential return, because if you get it right, well, now you could see those much more exponential returns. More risk, more potential returns, and you gotta know the game. If you want to be an active investor, great, but you gotta know it's gonna take more time, more effort, more energy, more research. And not to say that's a bad thing, but you got to know the game that you want to play. The problem and mistake that a lot of people make is they say, yes, I want to be an investor. I want to invest for the long term. I believe in this opportunity. I believe in this shift. And then as soon as you start to see some volatility in the market, you panic. And then you sell. And then you miss out on the opportunities. The reason why so many people lose money in the markets isn't because you necessarily make bad investments. It's because you let your emotions get the best of you. And this is where your financial education is important to get your money right. And then your research and plan as an investor is equally as important to deploy your money in the right way. And I have a ton of videos on my channel where I go over that. Market Briefs is a free newsletter where my team breaks down how you can understand what's happening in the markets. And in addition to Market Briefs, when you join Market Briefs, you'll also get a free masterclass on how you can invest your money as well. So if you haven't joined Market Briefs yet, again, I have the link for you down in the description, and I will see you on YouTube tomorrow.